I know there's a lot of noise about recession, recession, recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction. And that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now.
A global stock market rout was triggered by US recession fears on Friday. Japan's Nikkei experienced a 12% decline on Monday, its worst day since the Black Monday crash in 1987. South Korea's Kospi index was also down by 9%, and the Nasdaq plunged 6% seconds after the opening bell rang in New York. The crash spread swiftly through the markets, with top cryptocurrencies like Bitcoin and Ethereum experiencing their worst single-day declines since the FTX collapse in 2022 and 2021, respectively. The VX, a gauge of stock market volatility, has soared by almost 90% in days and is closing in on multi-year highs. Though the market rebounded slightly on Tuesday, a sense of uncertainty still hangs around. Many wonder if Monday's wild gyrations mark the final part of the global sell-off that started last week, or is the beginning of a widespread crash that could change the world forever. For popular macro analyst and former Goldman Sachs executive Raoul Pal, it's all business as usual. Pal believes the sell-off could, in fact, be a huge positive for the crypto market, as it will force central banks, like the US Federal Reserve, to start cutting rates and ending other quantitative tightening measures. In one of his latest tweets put out in reaction to the crash, Pal wrote, "I've been writing and talking for a while about the Chinese needing the dollar and yen lower so they could ease policy without sacrificing the RMB, and Yellen has been over in China twice to discuss this. US rates need to come lower too to help. That is now underway." The Japanese revaluation of the yen was part of a larger agreed-upon picture amongst central banks to be able to inject liquidity into the system to revive global growth momentum. A weaker dollar is what everyone needs to add liquidity and loosen financial conditions, and it will mop up this current mess caused by that regime change. King dollar no longer stands in the way. This is the big macro picture. Pal discusses this big macro picture further in a recent video, highlighting how this crash aligns with his predictions for the US and global economy, and, most importantly, cryptocurrency prices. As we bring you clips from Pal's video, please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks, and enjoy the video.
You see, what's been happening is we have needed stimulus into the global economy because the economy has been slow. The ISM survey has been bumping along the bottom. China's slow, Europe's slow. And you see, one of the component parts that allows for this all to move hadn't really been playing ball. Firstly, it was US rates, but the Fed gave us that signal. So that started moving. But the big one is King dollar. The dollar has been strong, and a strong dollar is a tighter financial conditions, which doesn't help markets and doesn't help economies. You see, at this point in the cycle, when there's no inflation or inflation is falling fast, generally, you need a weaker dollar. That brings global growth. So if you remember, Janet Yellen went to China twice earlier in the year. Those conversations, I believe, were about how we can allow China to stimulate without sacrificing the yuan. You see, if China had stimulated with the dollar strong, the yuan would have collapsed, and they can't deal with that. They really want to keep their currency stable. So they will have said to the US, we get it, we need to stimulate. We've got a debt deflation going on, but we can't stimulate. You need to help us. And Yellen would have said, of course, what can I do? And the answer is, well, obviously, you need to cut rates. And that's like, yes, we understand that. That's on the cards. But then it's like, you must weaken the dollar. So cut to the Bank of Japan. The Bank of Japan is the big player in all of this. And the Bank of Japan had been suffering from a weaker and weaker yen and the stronger and stronger dollar, and had started to make noises that it wanted to do something about it. So that the Japanese banking market is the Eurodollar market. It's the global lending of dollars, really comes out of Japan. And Japan didn't really have enough dollars. So what they had to do, the world doesn't have enough dollars. So Yellen will have spoken to the Japanese, as will have Powell. And the idea is listen, you intervene in the currency, that's injecting of liquidity. Help us start lowering the dollar. You can be the big driver here because this is how you operate your currency system. We will reciprocate by cutting rates. And the Chinese will be able to stimulate their economy without losing control of their currency. That's something I wrote about for a while, and I've talked about that this was the big plan. So we started to see yen intervention. Now, the thing about the yen, as the Japanese also raise rates, the thing about the yen is that a lot of people borrow in the currency because it's cheap, and then they invest in other assets. It's called a funding trade. And that's all well and good, and it can deal with normal volatility. But once the Japanese started to intervene in the currency, it starts knocking people out of their positions. Those positions become less profitable. So what happens is they are forced to reduce risk. In banks, it's called VAR and hedge fund, which is value at risk. So if the currency moves a lot, their funding currency, or in fact, any major currencies, what they have a tendency to do is start having to liquidate other positions. That started knocking into the NASDAQ, riskier assets, as people start reducing the higher volatility positions, and it knocks all the way through the chain of all assets. That's why you get this correlation of one event when everything moves together when they weren't correlated before. It's because everybody's forced to puke risk at the same time. So the risk puking had started and then really started to gather steam. Now, for all of us, this is like, what the are you doing? You're nuking my bags. I get it. But again, there's a bigger game to be played. The bigger game is they want liquidity into the system. And to do it, you're going to have a regime change. And that creates a macro spasm. Now, these macro spasms are not uncommon. You tend to get one every business cycle, particularly around regime changes. So, we saw one in 2018. That was at the end of the hiking regime. We saw then this spasm as the market essentially forced the Fed to pivot, the Powell pivot moment.
According to Pal, these macro spasms occur quite frequently during periods such as these. They are often short-lived, only lasting for a few weeks, but they pack a lot of sting and always end with central banks providing more liquidity to bail out the markets. For Pal, this could not have come at a better time for central banks, as it easily solves the issue of refinancing the world's massive debts at high rates. Central banks, including the Federal Reserve, have now been given an excuse to cut rates as aggressively as possible without causing widespread panic. Pal gives a simple summary of the situation in another post on X that reads, "Well, that's going to solve the issue of the global central banks having to refinance their debts at high rates. My guess is that rates over time come down to 2.5%. Next up, however, they will need large amounts of liquidity to monetize the previous cycle interest payments to roll it over. That will come in due course. More cowbell. We might even have war to add to the list of reasons to inject liquidity, but that comes with yet more uncertainty, FUD, and volatility. Instead of panicking about price movements, recessions, and the overall global economy, Pal says one should consider whether anything has changed in the business cycle. He points out that we are still at the bottom of the business cycle, with a massive easing of financial conditions in place, accelerated by the dollar and rate decline, and a host of forward-looking indicators showing signs of a good recovery ahead. The Real Vision founder and CEO discusses some of those indicators in his video. Here are more clips.
Now, the business cycle, remember I said, well, the business cycle is bottoming and not peaking. I know there's a lot of noise about recession. A lot of that was priced in back in 2022 from the forward-looking indicators. What we've got is the cyclical elements of the economy, car sales and stuff that are slow, miners and stuff that are driven by the business cycle. The business cycle is still chopping. Now, people say, yeah, but look, it rolled down. Yes, it did roll down. It happens at every low of every cycle. You tend to have this correction. And that's where we are now. So you can see the last 2 decades worth, you get this secondary dip before you get the recovery. So that's where I think we are now. It's kind of noise because most of the markets I concentrate on, crypto and technology, are priced off liquidity conditions and financial conditions. But We are at the relatively slow point of the economy where rate cuts are now kind of preordained. And the things that back it up are things like unemployment. I've been talking for a while that unemployment should rise. I don't think it's going to go super crazy. But now we're at the point where we're beyond the unemployment rate of the most negative Fed member. So obviously the signal is there to cut rates, and the Fed have made that clear. Maybe they come sooner, maybe they don't, maybe they inject liquidity in different ways. But either way, unemployment has been rising, and that is a key factor for the Fed, and inflation has been falling, which is the key factor for the Fed. So it's green lights all round to cut rates, and cut rates allows liquidity to come in to the system. So what happened is this mix of the DXY, which is the dollar, and the 10-year bond yields, and Fed rate cuts all came from the Fed starting to suddenly say, well, the market's starting to realize the Fed were going to change course, and then the Fed changing course by saying they were probably going to cut at the next meeting. And that set this whole thing off. Now, there's a lot of rate cuts priced in. They weren't priced in before, but I think they're more correct in how they're pricing things in. Will it work exactly how the markets are suggesting? I don't know. But I think rates come down to 2.5% or lower in this cycle. If you remember, the everything code needs low rates because you have to refi the $10 trillion of debt. So you need low rates to do that and liquidity to pay the interest payments on the prior cycle's debt, which is why the everything code is so important in this and why we keep repeating the same old cycle. It's because it's about paying the refinancing costs of the debt. And we're deep into the refi cycle. So I've been explaining for a while, the Fed and all the central banks need low rates. The Treasury needs liquidity within which to roll that and also to monetize the previous interest payments. That monetization of interest payments is what drives the liquidity cycle and the debasement cycle, which drives up assets. Also, as the business cycle bottoms, people have more money, businesses have more money, gets reinvested, people invest more, and that builds on a cycle. Things like emerging markets do well when the dollar weakens. So therefore, profits get reinvested in the system, and the virtuous cycle of macro summer and macro fall play out. And that should play out all the way into the end of 2025.
Crypto asset prices have experienced a sharp drop in the past week. Bitcoin is down by over 16%. And Ethereum by over 27%, having taken the worst hit among the top 10 cryptocurrencies. Regardless, Pal is still exceedingly bullish on crypto assets in 2024 and beyond. In his words, the banana zone slipped on a banana skin and took some nasty bruising, but it's all far from over. The concluding paragraph of one of his recent posts on X reads, "Eventual Fed cuts will usher in a weaker dollar period, which helps build macro summer and fall. Right now, we are in the maximum fear zone. Hold on tight and have a plan that suits your risk tolerance and time horizon. Zoom out and relax. This too shall pass. Remember, no leverage, no FOMO, top 3 to 5 assets as your main bag, self-custody, or multisig with good wallet hygiene. Only trade a small degen bag of less than 10%, hodl over a longer time horizon. Ignore the noise and buy the dip if you can." Do you think the banana zone is still in play, or are we upon a global recession that will cause even sharper price declines? Please share your thoughts in the comment section below. If you liked this video and want more like this, please smash the like button, subscribe to the channel, and check out our other videos featuring insightful analysis and super bullish predictions from some of the industry's brightest minds. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks for watching.